Welcome to The Explainer. You know, when the guy who famously predicted the 2008 housing crisis starts talking, people tend to listen. And right now, Michael Burry has a lot to say. Today, we are breaking down his latest, really critical analysis. It's a two-part thesis that warns of a huge bubble in AI, while pointing to a surprising opportunity in a name you'll definitely recognize.
Okay, so let's just start right here, because this says it all. This isn't just another market call for him. This is deeply personal. Burry is being driven by this powerful sense of regret, this feeling that he just didn't shout loud enough before the 2008 crash. And that history, it's fueling the urgency and the force of every single warning he's making today. So here's how we're going to break it all down. First, we'll get into his motivation, this prophet's regret. Then we're going to deconstruct his famous GameStop trade because, well, the story you think you know might be wrong. From there, we'll pivot to his stark warning on AI. After that, we'll see why on earth he's looking at GameStop again. And finally, we are going to tie it all together. All right, first things first, we have to understand the mindset behind all of this. This isn't just about numbers on a page for Burry. It's about a very painful lesson he learned from one of the biggest financial train wrecks in modern history. You see, he's looking at the AI sector today, and he's seeing the exact same kind of irrational hype that he saw with the housing bubble. So his current vocal stance, all those posts, all the detailed analysis, it's all a direct attempt to correct what he sees as a past failure. He is absolutely determined not to stay silent this time around. Now, to really get his warning about the future, you have to understand how the guy thinks. And honestly, there is no better case study than his legendary GameStop trade. He argues that the popular story, the one everyone knows, is just not what actually happened. Right, so the myth, the movie version, is that the whole thing was a retail army fighting a war against illegal, naked shorting. But Burry, who was in the trenches from the very beginning, says, nope, not quite. The real driver was a much more technical and totally legal market dynamic called a gamma squeeze. So what on earth is a gamma squeeze? Well, think of it like this. When thousands of people started buying call options, which are basically bets that the stock will go up, the market makers who sold them those options had to protect themselves from losing a ton of money. How'd they do that? By buying actual shares of GameStop. That buying pushed the price up, which, you guessed it, forced them to buy even more shares to stay hedged. It was this powerful, explosive feedback loop built right into the market's plumbing. No conspiracy needed. And this timeline is just so crucial for understanding his discipline. Look, he got in way back in 2019. Why? Because he saw deep, fundamental value in the company long before anyone was talking about memes. And then, and this is key, he got out in 2020, cashing out before the absolute peak of the frenzy. He's a value investor, not a gambler. He took his profits and walked away from the insane risk he knew was coming. Okay, so let's take that mindset, that deep fundamental analysis, and see how he's applying it to the biggest story in the market today, the AI revolution. Because when he looks closely, he believes its foundation is, well, incredibly fragile. Here is it, the core of his argument. Burry is saying that the hyperscalers, the giants like Meta, Microsoft, Google, are basically making their profits look way better than they actually are. And they're doing it by using some, let's call it, aggressive accounting for how long their super expensive AI chips and servers are actually going to be useful. And this table just lays it out perfectly. On the books, these companies are saying, oh yeah, these servers will be good for 5 or 6 years. But in reality, NVIDIA is pumping out revolutionary new chips every couple of years, making the old stuff obsolete way faster. The real lifespan is more like 2 to 3 years. So what does that mean? It means their real costs are much higher than the reporting, and their profits are artificially inflated. And we're not talking about a small rounding error here. Burry has actually done the math on this. He estimates that between 2026 and 2028, these tech giants will have collectively underestimated their depreciation costs by a staggering $176 billion. That is a massive financial hole that the market seems to be completely ignoring right now. And look, if you think this is just some outsider making a crazy prediction, get this. The CEO of Microsoft himself, Satya Nadella, has basically admitted this is a huge risk. He's publicly talked about getting trapped with old hardware that depreciates like crazy. That is a massive insider validation of Burry's entire thesis. So if Burry is this skeptical of the biggest, most loved stocks in tech, Where in the world does he see an opportunity? You're not going to believe it. He is looking right back at the company that became a household name, GameStop, but for totally different reasons this time.
This is the exact question that's guiding his entire strategy, right? If the market darlings are built on what he sees as an accounting mirage, the logical next step is to find companies built on something solid, something tangible, even if nobody likes them. And this is what he's seeing in GameStop today. I mean it. Forget the squeeze, forget the meme stock mania, just look at the company's books. They have a rock-solid balance sheet, a huge pile of cash, and almost no debt. It's a classic pariah stock, one the market has written off, but its fundamentals are incredibly strong. If that AI boom really is a bubble, then a company with this kind of financial fortress isn't just a potential value play, it's a safe harbor. It's exactly the kind of overlooked gem he loves to find. And he's even promised a new investment thesis for it in 2025. Okay, let's bring it all home and connect these two big ideas. This is not a random warning about AI and a separate quirky bet on GameStop. No, they are two sides of the exact same coin. It's one cohesive contrarian philosophy.
At the end of the day, it all boils down to a pretty simple two-step playbook. Step 1, doubt the hype. Be deeply skeptical of the hottest stories, especially when the accounting looks a little too good to be true. And step 2, find the real value. Go look for the unloved, forgotten companies that have something undeniably solid, like a fortress balance sheet full of cash. It's a philosophy of avoiding the crowded, narrative-driven bubbles and seeking out that tangible, overlooked value. And that right there is the provocative question Michael Burry's entire analysis leaves us with. It forces every single one of us to look past the headlines and ask, does the crowd have it completely backward? Is it possible that the market's biggest winners are far riskier than they appear, and its most ridiculed losers hold more real value than anyone can imagine? That is the heart of the contrarian bet.